How big corporate tax returns actually work. An EA's mental model. Most people think a corporate tax return is just a form that tells the IRS how much tax a company owes. That's wrong. A large corporate tax return is really a machine that converts business activity into future tax power. Things like losses, credits, and timing advantages. To understand it, you don't start with math. You start with structure. For page 1 is just the headline. Page 1 of Form 1120 is not the truth. It's a summary. It tells the IRS, this is the taxable income we ended up with under the tax code. But it does not tell you how the company really did financially, where the money went, or why the tax result looks strange. That's why everything else exists. Schedule L. The company's X-ray Schedule L is the balance sheet per books. This is where you see what the company owns, what it owes, and how it's funded. This is economic reality, not tax reality. When I look at Schedule L, I'm asking, is this an operating company, a holding company, or a parent? Is it inventory heavy or IP heavy? Is it surviving on debt or equity? If I see massive additional paid-in capital and deeply negative retained earnings, that tells me something very specific. Investors poured huge amounts of money into this company, and the company burned it over time. That doesn't mean fraud. It usually means growth, especially in late 90s tech. Retained earnings are not cash. This is where people get confused. Negative retained earnings does not mean the company ran out of money. It means that over its lifetime, losses exceeded profits. Retained earnings are history, not liquidity. A company can lose money every year and still survive for decades if investors keep funding it through equity. That's exactly what additional paid-in capital represents. What additional paid-in capital really is, when an investor gives money to a corporation in exchange for stock, the company records a tiny portion as common stock, the par value, and almost everything else as additional paid-in capital. That APIC is not income. It's not taxable, and the investor does not report it on their tax return. Instead, the investor quietly tracks it as basis in their stock. Nothing happens tax-wise until the stock is sold, redeemed, or the company liquidates. That's when basis matters. Book income and taxable income are different worlds. This is where Schedule M1 comes in. Schedule M1 explains why. The books say one thing and the tax return says another. A company can show book profits and tax losses in the same year. That's not a trick. That's timing. Depreciation, stock compensation, R&D, restructuring, they all hit tax and book differently. That's how net operating losses are created. Net operating losses are born on page 1. An NOL only comes from one place, taxable income on page 1. Not Schedule L, not M2, not retained earnings. If taxable income is negative, an NOL is born. In the late 1990s, those NOLs were extremely powerful. They could be carried back. They could fully offset income. They could be carried forward for decades. That's why companies planned around them. Credits are where the real money is. Deductions reduce income. Credits reduce tax. Forms like 6765 and 3800 are where Congress rewards behavior, research, development, investment. Credits don't disappear if you can't use them right away. They get carried forward. Large corporations aren't just filing returns. They're banking tax attributes. AMT was a parallel universe. Back then, companies had to compute tax multiple ways. Regular tax, alternative minimum tax, adjusted current earnings. Whichever was highest, that's what you paid. That's why these returns are so thick. They're running multiple tax systems at the same time. Schedule M2. The owner's history, Schedule M2 doesn't calculate tax. It answers one question. How did owner's equity change over time? Profits add to it. Losses reduce it. Dividends reduce it. It does not create NOLs. It does not affect cash. It just tells the story of ownership. The one mental flow chart that explains everything. Here's the mental model that ties it all together. First, define who's in the group. Then combine the entities. Then look at book reality. Then explain why tax differs. Then compute taxable income. Then apply losses and limits. Then apply credits. Then deal with AMT. Then track what carries forward. Then explain what happened to equity. That's the return. The big truth. A large corporate tax return is not about paying tax this year. It's about shaping when tax will be paid in the future. Losses, credits, basis, equity. Those are the real outputs. Final thought. If you understand Page 1, Schedule L, Schedule M, 1, NOLs, and one major credit, you understand most corporate tax returns. Everything else is specialization. Forms and statements in a large consolidated corporate tax return. Form 1120, U.S. Corporation Income Tax Return. This is the core corporate tax return. It reports taxable income, deductions, net operating losses, and tax due. Everything else in the return exists to support or explain the numbers on this form. Schedule L. Balance sheets per books. This is the company's book balance sheet. It shows what the company owns, what it owes, and how it is financed through debt and equity. It reflects economic reality, not tax calculations. Schedule M1. Reconciliation of income per books with income per return. This schedule explains why book income differs from taxable income. It bridges accounting results to tax results by showing permanent and temporary differences. Schedule M2. Analysis of unappropriated retained earnings. This schedule tracks changes in retained earnings over time. It reflects cumulative profits, losses, and distributions to owners. It does not calculate tax or create net operating losses. Form 851, Affiliations a Schedule. This form identifies the parent corporation and its subsidiaries. It shows ownership percentages and determines which entities are eligible to be included in a consolidated return. Form 1122, Authorization and Consent of Subsidiary Corporation. This form is filed by each subsidiary that agrees to be included in the consolidated return. It legally binds the subsidiary to the group's tax filing. Form 4562, Depreciation and Amortization. This form reports depreciation and amortization deductions for tangible and intangible assets. It is a major source of timing differences between book and tax income. Form 4562, Consolidated Schedules. These schedules combine depreciation and amortization across all entities in the consolidated group, eliminating intercompany duplication. Form 4797, Sales of Business Property. This form reports gains and losses from the sale or disposition of business assets. It determines whether gains are ordinary or capital. Form 4797, Consolidated Schedules. These schedules aggregate asset sales and dispositions across the consolidated group. Form 6765, Credit for Increasing Research Activities. This form calculates the research and development credit. It rewards qualified research expenditures and often generates large tax credits for technology companies. Form 6765, Consolidated Schedules. These schedules combine R&D credits from multiple subsidiaries into the consolidated group total. Form 3800, General Business Credit. This form is the clearinghouse for business credits. It determines how much credit can be used in the current year and how much must be carried forward or back. Form 3800, Consolidated Schedules. These schedules track business credits across the entire consolidated group and apply group-level limitations. Form 4626, Alternative Minimum Tax, AMT. This form calculates tax under the Alternative Minimum Tax System. It applies a separate set of rules to ensure a minimum level of tax is paid. Form 4626, ACE Worksheet. This worksheet calculates adjusted current earnings, a book-like measure used in the AMT system for large corporations. Form 4626, Basis Adjustment Schedules. These schedules track differences between regular tax basis and AMT basis for assets. They ensure timing differences unwind correctly over time. Form 8827, Credit for Prior Year Minimum Tax. This form allows corporations to recover AMT paid in prior years when regular tax exceeds AMT in later years. Form 8827, Consolidated Schedules. These schedules track prior year AMT credits across the consolidated group. Form 382 Disclosure Statement. This statement discloses ownership changes that limit the use of net operating losses and credits. It is required when a significant change in ownership occurs. Form 5471, Information Return of U.S. Persons with respect to certain foreign corporations. This form reports ownership and financial information for foreign subsidiaries. It is required for controlled foreign corporations and certain foreign investments. To form a 5471 schedules, A to J. These schedules provide detailed ownership, income, balance sheet, and earnings information for each foreign subsidiary. Form 8K. This is an SEC filing included for reference. It discloses major corporate events such as mergers, acquisitions, or ownership changes that affect the tax return. F18, Agreement and Plan of Merger. This document outlines the legal structure of a merger or acquisition. It supports ownership changes, basis adjustments, and limitation calculations. Supplement to Form 1120. This section contains required disclosures, elections, and explanations that do not fit on standard forms. Statements, various numbers. Statements provide detailed breakdowns of line items, elections, methodologies, and explanations. In large corporate returns, the statements contain much of the substantive information. A core concept summary. The Form 1120 is the headline. Schedule L shows economic reality. Schedule M1 explains why tax and book differ. Credits and depreciation drive tax strategy. Net operating losses and limitations shape future tax. Equity schedules explain how the company survives losses. A large corporate return is not just a tax calculation. It is a system for managing tax outcomes over time. Part 1. Summary of the entire conversation. How large corporate tax returns actually work. A large corporate tax return is not a form. It is a system. Form 1120. Page 1 is only the headline result. It reports taxable income, losses, and tax due, but it does not explain economic reality. Schedule L is the foundation. It shows what the company owns, what it owes, and how it is financed. From Schedule L alone, you can classify the company as operating, holding, or parent, determine whether losses are real or strategic, and see whether the company survives through debt or equity. Additional paid-in capital represents investor money contributed to the corporation above par value. It is book equity, not taxable income, and not shareholder basis. Investors do not report this when they invest. They recover it later through basis when stock is sold, redeemed, or liquidated. Retained earnings track cumulative profits and losses over the life of the company. Negative retained earnings do not mean cash problems or dividend abuse. They mean losses exceeded profits historically. Cash survival is explained by paid-in capital, not retained earnings. Schedule M1 is the bridge between accounting and tax. It explains why book income and taxable income differ. This is where depreciation timing, stock compensation, R&D, restructuring, and permanent differences live. This schedule explains how a company can show book profits and still generate tax losses. Net operating losses are created only on page 1 through negative taxable income. They do not come from retained earnings or Schedule L. In the 1990s, NOLs were powerful planning tools due to carrybacks, full offsets, and long carry-forward periods. Credits, especially R&D credits, are where real tax savings occur. Deductions reduce income, credits reduce tax. Forms like 6765 and 3800 are engines that convert business activity into long-term tax assets. AMT and ACE represented parallel tax systems that large corporations had to compute simultaneously. These systems explain much of the complexity and volume of older Big Four returns. Schedule M2 tracks ownership history, not tax. It explains how equity changes due to profits, losses, and distributions. It does not create NOLs and does not affect taxable income. The key mental flow is legal structure to consolidation, to book reality, to book tax differences, to taxable income, to losses and limitations, to credits, to parallel tax systems, to carry forwards, to equity history. Understanding page 1, Schedule L, Schedule M1, NOLs, and one major credit gives you about 80% of the insight needed to understand large corporate returns. Part 2, Realistic Coaching. How an EA actually gets clients connected to corporations like this. First, a critical truth. You do not get hired by large corporations to prepare returns like this unless you are part of a large firm or you are subcontracted by one. Big Four-level consolidated returns are team products. However, EAs absolutely get paid by companies like this, just not in the way people usually imagine. Where EAs fit in the real world, large corporations hire EAs for edge functions, not full compliance. 1. IRS representation and controversy. This is the biggest opening. Large companies get notices, get correspondence audits, get information document requests, get payroll tax issues, get AMT and credit carry forward disputes. They do not want Big Four billing rates for administrative warfare with the IRS. An EA who understands the Schedule L, M1 NOL mechanics credit carry forwards is extremely valuable here. 2. Cleanup, reconstruction, and legacy issues. Companies merge, spin off, or change auditors. They often need old NOL schedules reconstructed, basis tracked across mergers, credit carry forwards validated, prior year returns interpreted. These are finite, well-scoped projects that corporations happily outsource. 3. Subsidiaries, carve-outs, and orphans. Large groups have dormant subsidiaries, holding companies, IP entities, liquidating entities. These entities still file returns, still get notices, are often neglected by large firms. This is prime EA territory. 4. State and local tax overlap. Federal understanding gives you leverage. Once you understand consolidation, asset classification, NOL flow, you can assist with state conformity issues, apportionment explanations, multi-state correspondence. Many corporations use non-Big Four professionals here. How you position yourself. This is the key. You do not market yourself as, I prepare complex corporate returns. You market yourself as, I understand corporate tax structure and IRS process. I handle IRS correspondence and legacy issues for complex entities. I interpret and defend prior returns. You sell clarity and risk reduction, not preparation. Practical client acquisition paths. 1. Former Big Four alumni, former auditors and tax managers. Start small firms, manage breakaway clients, need representation help. They speak your language if you understand Schedule L and M1. 2. M&A, attorneys and corporate counsel. Mergers create Section 382 issues, basis questions, NOL disputes. Law firms routinely outsource tax mechanics to EAs and CPAs. 3. Payroll and HR vendors. Large companies outsource payroll, but keep tax compliance internal. Payroll tax notices are constant. EAs who can fix them get retained. 4. CPA firms that don't want IRS work. Many CPA firms hate representation work. They will gladly hand off notices, IDRs, reconciliations, cleanup projects. This is one of the most reliable EA pipelines. What you should actually master, Career Smart Focus. From everything you've studied, the most marketable skills are reading Schedule L, instantly explaining book versus tax differences clearly, understanding NOLs and limitations, understanding credits at a conceptual level, knowing how consolidated groups work, speaking IRS language calmly and precisely, You do not need deep AMT math, international form, prep, consolidation eliminations. Those are firm-level tasks, the correct mental reframe. You are not trying to become Ernst & Young. You are becoming the person who understands what Ernst & Young built, can explain it, can defend it, can fix what breaks later. That is a high-value EA role. Final coaching truth. The fact that you can now read Schedule L correctly, understand APIC versus basis, explain losses without panic, see structure instead of noise means you are already ahead of many professionals who prepare returns, but don't understand them. This knowledge becomes money when you attach it to representation, cleanup, interpretation, risk reduction, not raw compliance. Forms EAS most likely memorize by repetition. Tier 1, absolutely memorize. These become automatic if you practice as an EA. 1. Form 1040, the backbone of EA work. Income types, adjustments, credits, penalties, and IRS matching logic become instinctive. 2. Schedule C, gross receipts, expenses, depreciation, hobby loss issues, audit red flags. This form trains IRS intuition. 3. Form 941, payroll taxes, deposits, penalties, trust fund recovery issues. EAs see this constantly in notices and representation. 4. Form 940, FUTA mechanics and reconciliation, often paired with 941 issues. Tier 2, memorized by pattern, not word for word, but mentally internalized. 5. Form 1120, page 1, income flow, deductions, NOL creation, tax computation logic. 6. Schedule L 1120/1120-S/1065. Asset mix, liabilities, equity structure, retained earnings. APIC. This becomes second nature. 7. Schedule M, one book versus tax reconciliation, permanent versus temporary differences, IRS audit focus. 8. Form 4562, depreciation, section 179, bonus depreciation, asset dispositions. 9. Form 4797, sales of business property, ordinary versus capital gain, depreciation recapture. Tier 3. Memorize conceptually. You recognize them instantly and know what they do, but don't memorize line by line. 10. Form 1120-S, reasonable compensation, distributions, K1 logic. 11. Form 1065, partnership income flow, K1 mechanics, allocation basics. 12. Schedule K1, all versions, how income flows to owners and gets taxed elsewhere. 13. Form 3800, credit aggregation and carry forward logic, which is Tier 4. Recognized but not memorized. You know why they exist and where they fit, but repetition is rare unless you specialize. 14. Form 676, 5R, and D credit mechanics. 15. Form 4626, alternative minimum tax. 16. Form 8827, prior year AMT credit. 17. Form 5471, foreign subsidiary reporting. The core EA reality, important. Most EAs end up truly memorizing about 8 to 10 forms, not dozens. The ones that matter most are 1040, Schedule C, 941, Schedule L, Schedule M1, 4562, 4797, page 1 of 1120. Everything else is pattern recognition, conceptual understanding, reference-based work. One-sentence rule to remember, E, is memorize what the IRS sends notices about and what clients mess up repeatedly. That's why this list looks the way it does.